Well, thank you everyone for coming to today's Smart Money Town Hall. We are a bit lightly attended with the upheaval in Boulder this past week. I was not great about getting out and kind of getting the word out. So thank you all for being here, but a small group is kind of nice because we get to chat a bit more. So as usual, we're going to start out with just personal introductions and tell us what you do and kind of what field you're in. And it gives everyone a little bit of context for how we talk about how each of us talks about the economy. And then we are going to do our economic update with all of the numbers that you love and can't wait to get. But of course, I divide it up into color-coded and graded systems so it's easy to understand. And then we're going to get a bit of a discussion going. And today we're going to talk about diversification. What most people think it means and what it actually means, which of course we know that those two things are not always the same. So let's get started with our introductions. I will stop sharing my screen here and put us on speaker view. And I'm just going to go in the order that everyone is here. Camille, if you would like to start us out, take about a minute to introduce yourself. And then after Camille, Rachel.
Okay, thanks. Hi, I'm Camille Parker, and I am a book midwife / self-publishing consultant with My Word Publishing. Our goal with My Word Publishing is to facilitate self-published authors to put their books out into the world with minimum difficulty, with maximum help, and to make it the easiest for them to put their books out without having to go through a traditional publisher or go through a subsidy publisher who would take the majority of their royalties. So what we do is walk you through the process of putting your book out, working with editors and layout designers and cover designers and so on. And I do all the backroom stuff. So I help set you up on Amazon, get you set up with your publishing name and all that type of thing. So publishing industry is really booming right now and I love it. So there you go.
Wonderful. I am Rachel and I'm currently in Minnesota. I'm from Minnesota. I lived in Colorado for a couple of years, so that's how I know Melissa. But I'm currently in job transition mode. So I'm looking to get into project management. So I got my initial certification and I took another class last week for another kind of entry-level certification for project management and kind of looking to get into the tech industry. My brother works for Google. We got friends at SAP. So I know a lot about the tech world. But in my time of transition, I'm actually starting a little print-on-demand Etsy store. So my mom's an attorney, so I have my little LLC all right here that she gave me this morning to read over. So yeah, just doing that to get some money coming in while I'm looking for a job. And yeah, to be here.
That's awesome.
Awesome. Thank you, Rachel. That's really cool. Joshua is not here today as usual, so you can hold down the tech field end of the fort. So Robin, if you would like to introduce yourself, and then Jay.
Yeah, my name is Robin McIntosh. I am or was employed with the Transportation District. So I was in the transportation world. I was really more into the facilities world, but due to COVID and lack of ridership and a reorganization that went on at RTD, my job was eliminated. And so I am currently unemployed, not actively looking. That's the sad part, at least to society. I am just having fun, staying at home and taking advantage of this opportunity to get my house and my affairs in order.
Fantastic.
Awesome. Thanks, Robin. And I think I would call you happily retired instead of unemployed.
Yeah.
Jay, if you would like to introduce yourself.
Or you can call him happily unemployed. I think if you can enjoy unemployment, that's the best way.
Yeah.
You know, in my life, in my entire career, I was only between jobs one time for 7 months. And during that time, I went out on my boat almost every day and I lived it up. I collected unemployment. I felt I deserved a break, and that was the only time I ever did that. So anyway, and also, thank you, Robin. I never knew what RTD stood for.
Oh.
I always wonder, I thought it was regional transportation something, but I wasn't even close. Okay.
Run them down. That's what I heard.
Reason to drink.
That's awesome.
I hadn't heard that one, but that's even better. I'm Jay. My company is Total Speed. I bought this company about 13 years ago. My timing was perfect because in 2008, 2 months after I bought the company, the world economy crashed. And we're here for a webinar about economics and the economy, so that's kind of pertinent. And I merged Total Speed with my previous company called Computer Consulting, and we offer internet services that are all web-based and basically do it yourself. If you're familiar with what companies like GoDaddy does, that's what we do. So you can go to Total Speed, you can register domain names, you can set up websites, you can create email addresses, you can promote your website with email marketing, you can sell products with shopping carts, you can back up your website, you can monitor it, get notified if anything happens, we can fix it if you get hacked, all that good stuff. So at it for almost a quarter of a century. We're based in Boulder, and we love networking. And the website is totalspeed.co. I like to say totalspeed.co is all you need to know. Cool thing about my company, we're a full service provider, but our rates are better than companies like GoDaddy. And all our services that you pay for annually have a 30-day money back. So I encourage, if you're ever curious about our email or our website builder, sign up for it, try it out, use our email marketing. Oh, and the best one, our SEO is $7 a month if you pay monthly, $4 a month if you pay annually. It's nothing compared to what some companies charge. Wow. Because it's do it yourself. But all of it includes 24/7 phone support, and it's US based. We're not talking to China or India or Africa. And I just think it's a pleasant experience, and I love having chats with people and showing off what we do and signing people up. So totalspeed.co is all you need to know, because everyone needs Total Speed.
Awesome. Thank you, Jay.
And thank you, Melissa, for inviting me today.
Yes, thank you for being here, Jay. Jay and I have always gotten along because we have the same great sense of timing. I started my first business at the beginning of 2008, and I started working for Five Rings at the beginning of 2020. Yes, it's funny. I am Melissa Timmerman. I am here to help busy decision makers find financial freedom, and whatever that means to you. It can mean different things to different people. It could be the freedom to travel. It could be the freedom from work. It could be the freedom from college debt for yourself or your kids. But I am here to help people find whatever that means for them. I would like to say a few words today about the tragedy that happened in Boulder. Jay, I don't know how closely you were affected. Camille, Robin and I have spoken a bit. I lost a friend, and sometimes I have heard people say, oh, why do we keep talking about this? Why do we keep talking about this? And we keep talking about this because for 10 families out there, they are never going to see their loved ones again. It is completely preventable. It is completely unnecessary. It is cruel. It is very, very, very many bad things. And offering the support we can to the families out there, recognizing that this is a problem that needs a solution. Those things are important. And of course, I think the solution is, as Robin and I have spoken about, I think the solution is taking that asshole out behind the barn and shooting him, making sure he never makes anyone, prevents anyone from going home and hugging their loved ones. If anyone would like to add anything.
That was unofficial. Unofficially, we agreed to that.
I think I said that, Robin, not you. So you didn't have to stick your foot in it, man. I was there for you. I had you at your back. But if anyone would like to say a few words, you are all welcome to.
Yeah. What this incident reminded me of, sadly, is my sister was murdered by her estranged husband 5 years ago, almost 5 years ago, in lower downtown Denver in her office building. Chased her around and shot her and then killed himself. So it was a public domestic violence incident. And so anytime there's a shooting in public, depending upon, it's really weird. I get triggered, but I get triggered by different things each time. This time I got triggered by the fact that they brought in buses to interview all of the witnesses, because that's what they did for my sister. There were 120 witnesses for my sister's incident. And it threw me into a loop. So just like you, Melissa, I've had a bad week. And it, of course, happened the day before my sister was in surgery. So it's like all I've done is help my sister heal and try to heal myself. So this has been difficult. And I went to Arvada West High School, which is where the dude went. I have eaten at the restaurant that his parents own, because I grew up in West Arvada. It's been a difficult reckoning, I guess, because there's a lot of things that happen with when things happen in public. It helps remind us that we're all community, but it also makes it difficult because we are all community in some ways as well, because we have to face our pain and our loss and our trauma visibly to the public in a lot of ways. And some people do that better than others. Some people, hide it away and some don't. And everybody deals with grief differently. Believe me, I've had a lot of death in my life, through my whole life. And so I've dealt with it. And I tend to be sort of a grief counselor for a lot of people, just because I have gone through it a lot. Because then 2 years after my sister died, my other sister, the one who I'm staying with, her husband committed suicide 3 years ago. So it's been a difficult run, but every time it reminds me how important it is to have support, how important it is to have the crisis services I was amazed to see stuff on TV with the Boulder, showing the picture of the Boulder Flatirons and showing the crisis services phone numbers and websites and all that kind of stuff. Sadly, our communities in Colorado especially are good at that, because we've had many shootings, but thank God we have those types of things for people to be able to reach out and get help. That's all I can really say about it.
Thank you, Camille. And I am sorry for your loss. No one deserves that.
Thanks. So. Absolutely.
I hope things change. You spoke about your brother-in-law. I don't know if how his method of suicide happened, but what we know about gun violence is that over half of gun deaths are suicides. Over half of the remainder are domestic violence related. The old saw that I'm sorry, I'm going to move on to our economic update, because that is why we are here. Yes, if anyone needs resources, Camille, it sounds like you're the person to talk to. Bringing us back into the moment, into the present, if anyone would like to put their contact information in the chat and connect with each other offline, please feel free to do that, or private message each other, ask questions, make comments, etc., and let us carry on with our economic update. So I will start that. And we have had an awful lot of changes in the last month, which are super, super interesting. I think when we think about the past, we think about all of the broad changes that have happened over the last 10, 20 years. But when we look in the moment from month to month, there's always something interesting going on. So that's actually why I really enjoy doing these economic updates. So everyone has been here at more than once, but we always go over our top 5 economic measures, and those are broad categories of things to give us a better picture of what the economy looks like, because most of us really like to think about really just the stock market, right? Maybe GDP, but there is more to it than that. And so let's get into talking about employment or unemployment. So the unemployment rate skyrocketed almost a year ago up to almost 15%, which is one of the worst rates we've had since the Great Depression. But we have had unemployment spikes and drops all throughout the decades. I mean, it happens every few years. So this is particularly bad. But we're down at 6.2%, and an ideal unemployment rate is between 3 and 5%. If your unemployment is too low, everyone's got a job, everyone likes their job, and employers can't hire and expand. And of course, if unemployment is too high, then it means that employers don't have the money to expand, and there are a lot of families who are suffering because there are a lot of individuals who don't have jobs that they want to have. So we're going to give unemployment, we're still going to give it a good solid C. Yeah, we really still need to improve that. Many people think that the actual unemployment rate is actually much higher than 6.2%. Because the unemployment rate really only tracks people who are actively looking for a job. And there are a lot of people who cannot handle, say, homeschooling, childcare, and a job. They have loved ones at home that are sick and can't go back into the essential job that they had. So some people think that the unemployment rate is as high as 9 to 10%. So that definitely gets a good solid C. We need some improvement there. Moving on to our next, February actually gained almost 400,000 jobs, which is awesome. We are getting back our jobs, especially in terms of the service industry. Unfortunately, we are still down almost 9.5 million jobs from this time last year. And remember, February jobs numbers, that came before the big layoff in April. And so we really have a lot of work to do. And this $9.5 million number on the right here, our 12-month interval, that is what people think is contributing to that higher than real unemployment number. That real unemployment is higher than that 6.2%. That's borne out by the fact that we're still down 10 million jobs from where we were last year. Questions, comments, patterns people are seeing? Hourly earnings.
I'll make a comment. As an economist, I can tell you that the numbers that we use are really for comparison purposes. They're not accurate because there are a lot of people that have been up looking for jobs that are not counted. There are a lot of people that are severely underemployed that are counted as employed. So I would say realistically, we should probably triple or quadruple that number. But the government, since the unemployment counting has come out, has continually found ways to make it look lower and lower. But we can't ourselves be fooled. So use it for comparison, but not for reality.
Excellent point, Jay. Yeah, tripling or quadrupling that number. Yeah, that's a pretty severe unemployment rate. Hourly earnings
and also remember it's average, so it doesn't cover, people of color and communities like that can often have double the unemployment of other communities. So we have to consider how bad that is for cities and for our economy. Yeah, go ahead, Melissa. Sorry.
Yeah, no, that's great. I love the input because that's a point that I've tried to make pretty much every town hall. The recession we have seen is the most unequal recession we have seen in decades because places like the tech sector, I mean, Rachel, the tech sector is booming, right? There are so many jobs to be had. Olo is a company that creates the software that Grubhub and Uber Eats and food delivery services run off. They have quadrupled in the last 6 months. They're hiring like gangbusters. And so there are areas, real estate. I wish Maria was still here. A friend of mine is looking for a home. People are offering $80,000 over asking for homes in the Denver area. Real estate is doing great. Tech is doing great. But hourly earnings dropped here on this slide. We can see hourly earnings dropped just a teeny tiny bit. But when we see this spike here in early 2020, it looked like hourly earnings went up 7.5% last April. Did people actually make 8% more? No. But what happened was everyone with lots of people with low paying jobs lost their jobs because of the pandemic. A lot of essential services, which are lower paid, lower skill work, a lot of people in those sectors lost their jobs. So the people who had jobs remaining were already people who were doing better. They already were making more money. So again, we talk about, as Jay pointed out, we talk about this incredibly unequal recession in terms of job skill, in terms of poverty, that kind of thing. And so we do see hourly earnings tick down a teeny tiny bit, but we're not terribly concerned about that because what this actually indicates is that service jobs and lower paying jobs are actually coming back on board more. So employment in those sectors is ticking up, which sadly means the hourly earnings are going down. All right, next we go into housing, and there are about 16,000 different factors we can look at. There's about 16,000 different factors to look at when we look at real estate. We can look at how many homes are available. We can look at how many homes are being built. We can look at a lot of different things. And so One easy way of comparing, like Jay said, the numbers themselves don't matter quite so much because these numbers are actually edited over time to become more accurate. But what we do want to look at is the change. We do want to look at the trends and the changes. So in February, welcome Joshua. In February, we are down over 10% from how many housing units have started being built in January. Now, there usually is a little tick down in February, but not this bad. So we're going to give that not a great grade. So don't worry, Joshua, the economy gets better. You just came in at a bad time.
Well, I heard our cat, so I figured it was time to join.
She's going deaf. She's very loud. Now, of course, we come to my favorite slide, and maybe it's dumb to get excited about inflation, but everyone's got to have something, right? So we look at a couple of different things when we look at inflation. This is my favorite slide because this one usually has the most green on it. So when we look at the consumer price index, that is the price of a basket of goods. And when we look at that kind of basket of goods, we want to make sure that it's not rising in inflation too quickly. So any rate between 0 and 2% is a good rate, and that stays in the green. That is ideal. Now, month over month, inflation went up 0.4%. Year over year, inflation is really creeping up towards that 2% mark. And several economists have predicted that inflation is going to rise very quickly over this year, and that's completely pandemic related. So we see this 1.7 go up. It's still well within our 0 to 2% guideline, but it is ticking up a little faster than people want it to tick up. So this is something that we may see turn into maybe a B grade or a blue grade for us in our town halls here. So this is something to take a look at, not something to be concerned about yet, but we are seeing a trend towards not great improvement. So the consumer price index is really important to us as consumers. The producer price index is how much a basket of supplies and resources for a producer costs. And we look at this because it's a really good indicator down the road of if inflation will go up in the future. And as we can see, month over month, the producer price index is still well within that 0 to 2% ideal range. But year over year, that rate has gone up 2.8%. And I did make a mistake here. These numbers are for February 2020 to February 2021. I didn't change that from January to February here. But as we can see, the producer price index has ticked up over that ideal 0 to 2% mark. And so because of that, and because we can see that the consumer price index has risen a little too quickly over the last month and the last year, we can expect inflation to go up. So I might get real mad, and this might not be my favorite slide anymore. I feel like people in the economy should really take that into account when, they consider how they're making these numbers look.
Yeah, but Melissa, once they start raising the Fed fund rate, everything will balance back down.
Correct. And we talk about the Fed fund rate next. The Fed is keeping the Federal Reserve funds rate at 0 to 0.25%. And that is a way to control inflation. On a consumer level, this number is kind of what your mortgage rates are based on. And so keeping this number low helps control inflation, but keeping it too low for too long can have a negative effect on inflation. So we probably can assume that the Fed will change this funds rate anytime between March and June of this year. They probably will raise that to help control inflation. It's not a bad thing. It's actually an excellent tool to keep things in the economy less volatile. Moving on, spending, GDP, is how much we produce as a nation in goods and services. And this measure is only taken every quarter. Every month it is adjusted to be a little more accurate. And so I am happy to report that Q4 of 2020 ticked up from 4.0% to 4.3%. So the economy grew a little teeny bit more than we really thought. So that's a nice change to see. And let us move on to how much people are actually spending. So retail sales are all of the things we buy in stores and retail, everything we buy on Amazon, that goes into these retail sales numbers. January numbers look really good, up 7.6% from December of 2020. And so I actually want to spend a minute on this slide because what I'm seeing here is very interesting. So December of 2020, retail sales were actually down a little bit. And that's unusual because November and December are really big retail months because of the holidays. So it was unpleasant to see that tick downward in December of 2020, but January 2021, people spent 7.6% more than usual. So that really evened out. So that kind of takes away that worry that, oh, December was bad. What's happening? Is something going wrong? Absolutely not. Just people bought things at the end of December and beginning of January instead of the beginning of December. And so now we see that February has gone down about 3%, but I actually give that a B. 3% seems like a lot. But again, like Jay said, we look at trends over time, and spending almost always goes down in February from January. What happens in mid-January? People get their credit card bills. So while this retail sales number doesn't look great, it's really not something to worry about very much, and it doesn't indicate a trend that that anything is wrong in the economy. When we look over at durable goods, again, what we look at a lot in this town hall are predictors that kind of help us look at how things might happen in the future. And so durable goods is actually a measure of confidence in the economy. If people are buying things like appliances, if they're buying things like air conditioners and cars, those are things that are going to be around a good long while. And so people have to have the confidence that, yes, I'm going to have my job, I can afford this. So durable goods is a great thing to look at when we look at a measure of the economy as a whole. And again, all goods and spending generally go down from January to February. So a decrease of 1% isn't concerning here at all. So retail, we're doing just fine. Everyone take your paychecks and spend as usual, feel free. And now we're going to consumer confidence. So consumer confidence is actually a really good measure of the economy and something we want to look at. The dollar is not backed by a gold standard anymore. What props up the dollar? Consumer confidence is actually a really important part of that. And so we look at two different measures of consumer confidence. First, we look at the leading economic index, and this is a newer measure that was put into place about 5 years ago, 4.5, 5 years ago, and that was put into place as a more comprehensive measure because as we study more things and collect more data, they were actually able to come up with a much more complicated algorithm that was a little bit more accurate of a measure of how confident people are in the economy. And so that leading economic index actually ticked up a couple of points from 108 to 110. And the leading economic index is something that business people look at when they're deciding whether or not to put more money into their businesses or not. So this business guy is like, yes, we are doing good. We're going up in the economy. We are doing just fine. And then we look at the consumer confidence score, and that ticked up a teeny tiny percent. That ticked up just a little bit. And so here we have people very excited that consumer confidence, we're seeing some movement. We're getting a little bit better. So consumer confidence is always great to look at. And next we look at the one thing that most people think of when they think of economic performance, the stock market, which is really funny because here's a statistic for you. Can anyone guess how many individuals in America are invested in the stock market? When we look at the stock market, how much of the stock market is individuals investing and how much is businesses investing? Does anyone know? About 10% of the stock market, 10% of the money that's in the stock market is from individuals like you and me with our 401ks. Most of the stock market is actually about how businesses treat each other and how businesses are investing in each other. That's pretty shocking, isn't it? We all kind of have this personal connection to the stock market because we have a 401k or our spouse does, or, that's kind of how we think of things. So the stock market is doing great. And so when we have 10 million fewer jobs, when we have fewer people being able to afford new homes, When we have retail sales going down, all those measures are not great. So why is the stock market so high? Because again, this is the most unequal recession we've ever had. The people who already have money, the businesses, the people who have steady 9-to-5s with 401ks, they're all doing great. There's only a fairly small sector of society, low skill or lower skill, lower paid jobs. Those are the people who are suffering. So again, I think in the next 10 years, we are going to see a much more drastic divide between the haves and the have-nots. We're going to see the gap grow between the rich and the poor. I think that's what this excellent stock market performance indicates. We can continue to ride this wave of the stock market actually doing pretty well, or some of us are really enjoying getting some of our money out of the stock market at a high and then putting it somewhere safer so that we can enjoy that growth and yet never participate in any losses as we move forward. I think that's kind of one of the more exciting things to do in the stock market right now. So moving on, what does it all mean? What does it all mean? Here we have quite a lot of blue, a little bit of green in there. GDP is good, stock market's great. Inflation, currently my favorite measure, but we'll see how they treat me in the next few months. I might withdraw my favorable impression. We're still struggling a little with housing and unemployment. And I think that leads us all to a good solid B. We've been there a lot, but you never want to see your grades go up and down in a volatile way, right? So we're okay with things staying at a B right now. I was actually considering going with a B plus because we do have some good measures of the economy. So I think if things continue to get better, we might inch towards that B plus status in the next month or two. So now we have some good data. We've got some good interpretation. How are we all feeling about this? It's time for our discussion section. I'm going to stop sharing. So what are you looking forward to? What's your biggest fear? Do you see anything coming down the pike that maybe I didn't in your own industry or in the economy as a whole that we didn't cover in our update? I will stop sharing and we'll switch to speaker view here. So what does everyone think? Does anybody have any comments?
I guess the first thing I would say is, I guess not really a fear, it's just more of a concern, is with people getting their shots, that we're going to end up having another big surge. And that's going to pull confidence back again in all areas of our world. Because obviously if there's another big surge, then that's going to affect restaurants, hotels, travel, all of that, which are just starting to really get back into a groove. And I think that, and again, going back earlier about a lot of the lesser paid positions are, retail and restaurants and stuff like that. So keeping that in mind, that's, I guess, what my biggest concern is. And in the fact that we live in, that Colorado is very highly tourist driven as an economy in our state. I think that's kind of a concern. But I've been through recessions in this state. So I grew up here. So it's like I've been through many recessions in this state and many issues. And, we're well diversified, going back to what we're going to be talking about later, in our state. Back in the 80s when, I literally graduated from college in 1987, right before Black Monday hit in October that year. And at that point, Colorado was very much an oil and gas driven state. We had no diversification whatsoever, which is why it hit us first and fastest. And I don't know if Jay would agree with this, but something I've heard through my entire adult life is that Colorado is very much driven by that we are like the first to crash and the first to come out. So we are very much a leading indicator of how the country is going to survive through recessions and downturns and so forth in the economy, where typically a lot of people assume it's always, from the shores in. For some weird reason, Colorado is a really big indicator of stuff like that. So anyway, but I think we're going to be fine. It's just going to take a little time.
Yeah, Denver is like an enormous hub for shipping industry. We're a nexus in the Rocky Mountain region for healthcare and technology.
Right.
So yeah, we are a leading indicator. Jay, what do you think about what Camille said?
Well, I was just going to make a comment on one of the things Camille said. Last weekend, I went to my girlfriend and I went to a hotel in Colorado that was booked solid. We were lucky reservation, and
Yeah,
we had to wait 5 people before we could get to the desk. Now, I don't know if that's representative, but it's hopeful.
that's awesome. That makes me so happy.
That's good.
Yeah. Yeah.
Robin, Rachel, Joshua, what do you guys think?
Well, if you're asking, I'm not sure. I love the fact that Camille brought up the vaccine because I'm curious if it's going to go, it's going to make a difference. Either everybody's going to have there's going to be another surge. Everybody's going to do what they normally do and relax too soon. That's just our nature. Or the vaccine actually does its job and that herd immunity gets developed.
Correct.
And we can walk around and have confidence in each other. You talk about consumer confidence. I'm more worried about the confidence in each other. We walk around and somebody coughs and everybody just kind of like birds sway away, and move. I even notice Rachel over there. I'm like, well, I'm glad I'm not next to her when she's sneezing or coughing, whatever she's doing. It's like, it's really, it's created a really bad interaction between humans. And I'm very concerned about that. Not just after the vaccine, but moving forward, because obviously there's some new strains coming out. It's funny that usually when you're talking about economy, you're talking about money, but really, the last year has taught us that it's not about money; it's about how we interact with each other and the confidence that we have, not only in doing business with somebody, but also interacting with them. And I'm so nervous about this transaction that I'm doing right now. I want to have a check and walk into the bank and know that it's, this whole error going back and forth and in the mail and stuff like that.
Yeah.
It's just driving me crazy. I'm just going nuts. So anyway, those are my opinions.
Well,
We'll get you
a
taken care
comment
of,
about what
Robin.
Robin said. I can't help but if I watch an old movie, something from the early 1900s or mid 1900s, people were so packed together. And now, from our perspective, when I look at that, I cringe. I say, oh my God, I can't imagine being amidst that many people shoulder to shoulder like that. But we've changed our outlook.
Yeah, and even before the pandemic, you go into a theater and you're still like this far away from anybody that's around you in the theaters because they've done these huge, recliner chair style in it
I don't
basically every
mind that.
theater.
Those chairs are so comfortable.
Oh yeah.
I don't need someone that close to me. I don't mind a little, I don't mind someone not bumping my arm, and it's comfortable. And so in some ways it's an improvement.
It is, and I think it is changing how we treat each other socially. I mean, I don't know about you guys, but my spouse is on this call and we go through stores and we go down the street and we talk about, oh, did you see that dirty little disease monger? Otherwise known as another American. I mean, there's this suspicion in how we look at each other, and I think it will change society. And I do not see this as completely negative, but we are more and more likely to see more pandemics in our future as we interact more and more closely with animals who can transmit diseases to us that we are not prepared for. So this might be the worst. And hopefully, what I don't see that as really bad, because hopefully what we're going to do is we're going to build up an infrastructure and we're going to build up a process that we can deal with these things better in the future. So I really do think and hope that this is the worst that we will ever see, but this is not the last that we will ever see, if that makes sense.
Melissa, I have a question relating to what you said before we got into the pandemic part.
Mm-hmm.
One of the things that concerns me, and I don't really hear people talking about this, is throughout my history in life, I've experienced the stock market going up and up and up. And when it gets to extremes like this, I hear a popping sound. And I don't hear concerns about that. Should we be?
They're actually, I know exactly what you're talking about. And what we think about is we think about a bubble. We think about something expanding far, far, far too quickly, and then poof, it contracts in a really difficult, painful manner. We're actually not seeing a bubble right now, because again, it actually has to do with the state of our economy and the fact that this is an unequal recession. The growth that we're seeing in other sectors is not artificially inflated. It's actual real growth. So the growth we're seeing in this,
companies buying back their stocks, inflating their prices, we're seeing actual growth.
correct. We are seeing real growth. We are seeing real investment. Some of it's not super ethical, people taking PPP funds that they didn't really need. But most of the growth we're seeing in the stock market is real growth, or as real as it can be. I mean, we know that a company's measure of how its stock is valued is not the actual company value. Like, we know it's a measure, it's an indicator, it's not super correct, it's not
That's what
super.
concerns me a little bit about the real estate market. I heard just recently that in Denver, people are paying $1,000 above asking price for property. That can be a bubble. But if so,
that's also not considered a bubble, because another thing about real estate is that a lot of it has to do with how many houses are available on the market. Right. And so if prices are inflating an awful lot and there's a lot of houses on the market, that would be considered more of a bubble. But right now, the interplay of all those factors truly means that we are not in a real estate bubble. We will see a correction. We're probably not going to see housing prices dip, but we are going to see these crazy waiving inspections and tens of thousands over asking. We're probably going to see that correct itself in the fall. That's when things do tend to correct themselves. So we'll probably see a correction there, but not a bubble burst.
Okay.
Yeah.
It makes me uneasy. Things seem to be going really, really well, but we know there's a great sector of the population that's not doing very well.
Right.
So I think what we might see.
I was going to say, part with the housing as well. Part of it too, it's very definitely, obviously, a seller's market right now, and getting it to the point where it's balanced that's going to be the key. And part of that will happen with what's been going on, as you noted in one of her slides. Housing starts is what's going to help. Once we get the construction going back up and so on, getting more houses out there for people to actually buy, then that'll balance out again. Not completely, but that'll help balance it.
Sorry.
As a note, Amanda, please speak up, but as a note, Denver, Colorado has not been a balanced market for over 12 years. We have always been some version of a seller's market. And so the idea that it just naturally balances between the two does not play out in Colorado. And we have not seen a bust, Jay. We have not seen a real estate bubble burst since 2008.
Yeah, because I sold a house in November of 2007, and I literally was right on the edge, where it's like I bought and sold pretty laterally. And that was totally fine for me, but I was lucky, really lucky.
What, Amanda, your perspective on real estate?
Yeah, so I'm not a real estate person, but one of my clients is, so I've been even more educated than I normally am on it. And it's really more of an economics thing at this point, where it's a supply and demand thing. So there's the reason why we're having so many 80 grand above asking price is because there are not houses available for people, and they're having to fight, and they're getting a house is getting multiple people interested in it, and then they're having to basically bid for it just to get it. And so that's why there's this above asking price, potential issue that everyone's like, oh my gosh, they're getting in, they're above that average price. Isn't really because of the bubble issue that we had back in 2008. It's more because we don't have these houses that are available, and so it's causing demand to increase the value of them. And then the new build thing was interesting too, because a lot of people I know, like our neighbors here, were trying to buy a house and they couldn't get in the market because it's too competitive right now, and so they had to, they're trying to have to start from scratch and do a new build. And I'm seeing a lot of my clients doing that as well. When they can't get into an existing house, they're starting to do the new builds. So yeah, it's really interesting, because like when I first saw it too, I was like, oh my gosh, we have another bubble. Like, and then with, you know, when I started hearing that everyone was paying over asking price and everything. But now that I'm actually like doing the research and for my client part, I was like, oh, it makes, you know, it's a little different now. It's not exactly what was happening, where people are getting, because I think back in 2008, people were getting qualified for houses they couldn't basically pay for. And like, that's what was going on. So this is a little different. It's basically outbidding them. So yeah, so the housing market's very interesting right now, and it's definitely going crazy. And I find it fascinating because it's not I'm a marketer obviously, but it's really interesting to see it from my client's perspective and like what her clients are doing. Yeah, it's really interesting right now.
Cool. Yeah, my parents, they're going out to late April and early May to start looking for properties and houses out there, because they're thinking they want to retire out there. And I'm interested to see what it's going to be like for when they're looking, because, you know, they have a friend that's out there and they're doing a new build, and I mean, quite wealthy. So they're, you know, a few $1 million house, but it's interesting. And they said, you know, her friend that lives out there said the appreciation rate in Utah has been like 40% within like 4 or 5 years. So it's ridiculous. Yeah. So it'll be interesting, and I'll keep you guys updated on what they find when they get out there. So we'll see.
Yeah, that would be great, Rachel. I imagine all the Mormons having 7 kids and all those kids growing up and wanting houses. You know, their need for housing is worse than ours. So.
Yeah.
Thanks for laughing. I think I'm funny. So let's move into our education portion. Today we're going to talk about diversification. And so what does diversification mean? When it comes to your personal finances, what does diversification mean?
Not putting all your eggs in one basket.
Exactly. And most of us, when we think about diversification, we think one thing. We think, oh, I'm diversified. I own stock in both Microsoft and Apple. No, that's not what we mean. So when we first look at diversification, we want to look at our options. When people think investing, most people think of one thing first. They think of the stock market. But there's about 10, 12, 14 different things you can actually invest in, many different types of vehicles. And they really vary in one major way. They vary in how risky they are. So when we look at risk, we kind of have this teeter-totter where things balance between risk and safety. And when we think of risky vehicles, the stock market is actually an incredibly risky vehicle. Risk doesn't mean bad. Risk simply means that you have the opportunity to grow a lot, but you also have the opportunity to lose a lot. That's what risk means. So the stock market is risky. Investing in commodities, investing in futures, extremely risky. And when we think about things that are safe, those are things like checking and savings accounts, your money market, bonds. These are things where you never lose. You always know exactly how much money you have at any given point. But what we don't like about that is it just doesn't grow very much. And each of these vehicles is somewhere along the risk versus safety line. So where all of us really want to be is right in the middle, where we can grow a lot but never lose. And there are vehicles that allow you to do that. There are many vehicles that allow you to do that. So checking and savings is probably as safe as you can ever get. It's way over here, right? And bonds, you grow a little and they're really, really safe. So they're right here. And so everything that we invest in is at a different place along the risk versus safety line. But what I want you guys to think about today in terms of diversification, not just in terms of what we can invest in, but think about where you are along this risk versus safety line. All of us are at a different point based on our background, based on our personal preferences, based on our age. the older you get, generally, the more you care about safety, because when you're 20, you think, oh, I don't really care about building up. I have so many years to worry about it. But when you're 65, 70, you realize if I take a big risk and I lose, I don't have enough time to make that up. So generally, the older we get, the closer we get towards the safety side. Gender plays a role. More women tend to be risk averse than men. Men, another way of saying it is men tend to be more risk tolerant. And to decide where you are on this risk versus safety line, a good question to ask is, when something happens to you, do you care more about what you lose or what you have the potential to gain? If you get in a car accident, do you think, oh, now there's damage to my car and it's going to negatively affect my value when I trade it in because there's going to be an accident showing up on the report? Or do you tend to think of the whole, oh, look, I could get a new car out of this? So do you tend to get excited by gains, or do you tend to get more upset about losses? The more upset about losses you get, kind of the closer on the safety side you are. So evaluate your own tolerance for risk and kind of try to match, if you're here on the risk versus safety side, try to look for a vehicle that matches that. When we think about risk versus safety, real estate, you can gain, but you can lose. So real estate kind of is right here. So if you're here on the risk versus safety line, use your own personal risk tolerance to kind of evaluate. Use your own risk tolerance to kind of evaluate where you are on that and choose appropriate vehicles to invest in. The stock market is not our only option. A lot of people think it is because that's what we've been told by our employers for decades. This is how to invest: a 401k, a pension, a 457b. And those generally invest in the stock market. They're not the only way to do it. So take your personal tolerance into account. Another way to consider your tolerance is something we call the rule of 100. So your risk tolerance, a good rule of thumb is using the rule of 100. So take 100, subtract your age. So if you're 20, take 100, subtract your age, you have 80. 80% of your investments should be in riskier vehicles. 20% should be in safe vehicles. If you are 65, rule of 100, take 65 away, you have 35. 35% of your investments should be in riskier investments. 65 should be in safer investments. And so take that rule of thumb and then kind of evaluate, no, I'm more risk averse. I want more of my money in safe money. Okay, I'm more risk tolerant than that. I want more of my money in risk tolerance. So diversification doesn't just mean I own stock in both Microsoft and Apple. No. When you diversify, when you truly diversify your money, you should have some of your money in risky vehicles and some of your money in safe vehicles. And the proportion of that is extremely personal. But if you are in the wrong profile, you're always going to feel uneasy about your money. Your expectations are not going to align with your actual returns. And so if you are not in the correct risk profile for your own personal diversification, you are always going to be disappointed with how you're accumulating wealth. You're always going to be uneasy about where your money is. So make sure you feel good about your own personal risk profile, and then you will invest your money in the way that works best for you, and you will feel much more confident and much happier with your results. Any questions? What do people think? Do people prefer not to think? It's already Tuesday. Are we on Friday mode yet? I think it's a ski day for everyone.
Melissa, I really liked how you had that the example about, if you're in a car, if you were in a car accident, which way do you think about it? Because, when you're starting out, a lot of times you're like, oh, this is how I think I would be, or how, like, yeah, I'll take risks or something like that. But when, you know, I feel like someone who's a little bit more, sometimes he takes more risks, but when you said that, like, I immediately was like, oh my God, like it's the opposite. It was like, oh my God, like I don't want a new car. Like I need to, you know, figure out how this is going to be, you know, and how much money I'm going to get from the old one and all that kind of stuff. So it isn't a really great, I thought that was a really great example of what, how to like assess it yourself.
Yeah. And most of us are very surprised. I mean, I think a lot of us have heard this gender idea that men are more risk tolerant and women are more about financial security. But I was talking to a guy just yesterday and I brought up this idea to him. Are you more risk averse or risk tolerant? And when he really thought about it, when it was asked the question, he realized, oh, no, I am really risk averse. And so then I thought, well, if you're thinking about putting more money into your retirement, you're not going to want risky vehicles. It's never going to feel good to you. And just, you know, mind blown. He had never thought about it that way before. And I felt really good because he's going to put his money into a place that feels better to him, no matter what his brother-in-law says or his boss says or anything like that. So yeah, being appropriate is more important than anything else. So, any final thoughts from anyone? All right. Well, thank you all so much for coming. I hope you'll be here next month. Next month, we will be meeting Tuesday, April 27th. So I will be happy to see you all there, and hopefully we'll have a slightly larger group with even more diverse perspectives. I love all of you. All of you have these great ideas, and I love hearing your thoughts. So
Thank you so much. Everyone have a wonderful month.
yeah, thanks for being here.
Thank you.
Thank
I-
you.